Good morning, folks. My name is Jimmy Bashar with the ISO Stakeholder Affairs, and it's my pleasure to welcome you to the latest Day-Ahead Market Enhancement Stakeholder Meeting. Our agenda for today's meeting is to discuss both phases of this initiative. As you can see, we will continue discussions over how we've shaped our Phase 1 proposal to address stakeholder input to date, and then we will move on to discuss the second phase of this initiative after the lunch break. As you may recall, Phase 1 addresses both 15-minute scheduling and 15-minute bidding proposals, and Phase 2 will address the day-ahead market formation, a proposed day-ahead flexible ramping product, or the FRP for short, a proposal to improve deliverability of the FRP and ancillary services, or AS, and then finally a proposal for a re-optimization of AS in the real-time 15-minute market. As most, and hopefully all of you know by now, this is a simple display of our stakeholder process, which, as you can see, utilizes the input obtained by stakeholders between each proposal iteration, after which we carry the proposal forth for board consideration. And as you can see, we are in the straw proposal stage for Phase 1, which is due for consideration at our July board. Here's also the current timeline for Phase 1 moving forward. As you can see, after this third revised proposal, we are due to publish the draft final proposal in April prior to going to the EIM governing body and the board meetings. Here's also the current schedule for Phase 2, with the next proposal currently slated for publication this summer. You can see here's the timeline, with currently targeting the Q4 2019 EIM governing body and board decisions. In addition, the calls and webinars are recorded for stakeholder convenience, allowing those who are unable to attend to listen to the recordings after the meetings. The recordings will be publicly available on the ISO webpage for a limited time following the meetings. Of course, the recordings and any related transcriptions should not be reprinted without the ISO's permission. And lastly, of course, if you have a question in the room, please raise your hand and press the mic button once and release, and then press it again to turn it off once you're through commenting. And for those on the phone, you can raise your hand by pressing #2. And for everyone, of course, please state the name and the company that you represent. And without further ado, I will hand it over to Megan.
Good morning, everyone. Happy Thursday. We almost made it to Friday. Thanks for joining us here in person and on the call. It's been a few months since we've last chatted about the day-ahead market enhancements, and we took this opportunity to talk both about Phase 1 and Phase 2. So I'll be presenting the Phase 1 third revised straw proposal this morning, and then I'll pass it off to Elliot in the afternoon to discuss Phase 2. Don just did have a brilliant thought, so I'll give him credit and state this now. We noted in the papers that the comment submission deadline would be our standard 2 weeks. We recognize that for 2 proposals, 2 weeks might be too soon. So while we are requesting the Phase 1 comments within the 2-week submission timeline, that will enable us to make it to our EM governing body and board in June and July. We're open to the idea of extending the comment submission deadline for Phase 2 if that additional time is needed. So think that over as we're going through the meeting today, and we'll revisit that at the end of the meeting if that would help it. So with that, we'll go through Phase 1. A lot of this is review. I'll point out specifically the items that are new, but because we haven't discussed this, I think it was last August, I'll make sure to answer any outstanding questions. We'll revisit all of the topics. We anticipate that we'll be able to turn this around quickly with minor changes for the draft final proposal. So at this point, we're really just looking to cross the T's and dot the I's and wrap this proposal up. So with that, I know you guys have seen this slide before. This is actual data from a trade date. It was sometime in February of last year. And this is our ISO load forecast, the actual demand in relation to the hourly forecast as scheduled in the day-ahead market. The reason we think this data is very telling is you'll notice that the first half of the day that the load forecast is simply off. The actual demand came in significantly lower than what our day-ahead schedules cleared in hourly blocks. The second half of the day, however, you'll notice we had some granularity differences. Our hourly schedules right now clear demand from midpoint to midpoint of each hour, so even though our forecast in hourly blocks was as accurate as it could possibly get, you still have major changes at the beginning and the end of the hour. So for example, right at 2200, actually at the starter end of any hour, but I was looking at 2200 specifically, and you have approximately 23,000 megawatts scheduled for that moment in time. However, your demand that came in was about 24,000 megawatts. That's the actual demand. So even though our day-ahead market scheduled as accurately as it could, you had 1,000 megawatts of granularity difference for that first interval of the hour, with which the real-time market needed to make up for that 1,000 megawatt difference between the day-ahead schedule and what actually materialized. So the purpose of the phase one part of the day-ahead market enhancements was specifically to address these large granularity changes within the hour. And we propose to do that by introducing 15-minute scheduling into the day-ahead market. The uncertainty on the first half of this trade date will be addressed by introducing a flexible ramping product, and that's what we're discussing in phase two. So this is an important overview and really sets the stage to distinguish the purpose of phase one in comparison to phase two. So I want to ask right now if there's any questions on the difference between the granularity differences you notice in the second half of the day, which we'll address in phase one, or the uncertainty that exists in the early half of the day, which we'll address in phase two. Any questions in the room? Any questions on the phone line? Good, we all remember. Oh, we do have one. I'm sorry, it's okay, you're still allowed to ask a question. Go ahead.
Good morning, Megan. This is Aditya from Southern California Edison. First off, thank you for the presentation and the papers. I don't feel as much as, this, at least in my end, that this proposal is fairly wrapped up. I'm actually much further behind in my mind, in my understanding of really how this entire proposal is going to function. And I'll clarify real quick. So I understand you're talking about the granularity part first, and then later on we'll be discussing FRP procurement. However, to me, at least the first part, phase one, granularity, has a lot of implications on how FRP procurement and the other parts of the proposal are going to pan out. I don't have a clear understanding, really, or very limited understanding of how the CAISO is proposing to, with the 15-minute granularity, go ahead, determine its need, go through procurement, go through selecting units for awards, how prices are set. I don't have understanding of any of this at this point. So I'm hoping at some point.
Question?
I'm sorry?
Can I ask a quick clarifying question?
Yeah, please go ahead.
When you say procurement and unit commitment, are you talking about the procurement of the flexible ramping product, or are you talking about just energy commitment?
Yeah, so as I understand it right now, energy, FRP, and so resources, it will all be co-optimized. I want to understand how, with the 15-minute granularity in IFM, how the CAISO is, well, first off, how are they going to determine the need of FRP? Let me put that ahead first. There was a proposal, the proposal talked about, a demand curve. Okay, can you be more specific, the actual details? A walkthrough similar to, I believe, several iterations ago, the CAISO had given, and that was a different proposal, I understand, but the CAISO had given a numerical Excel solver spreadsheet with a lot of details laid out. I'm not saying that's the only thing necessary, but that would help to get an understanding of what, first off, is the need. How are you going to first target the need for FRP? Given the target need for FRP, how are you going to co-optimize, how are you going to co-optimize FRP, energy? You also mentioned corrective capacity. I'm way behind on that because I have no idea about corrective capacity. Corrective capacity and energy resources. How will these products be procured in terms of when there's a resource coming in an example we can provide, when there's a resource coming in, how are you going to choose which product it's going to provide? How is that?
Yeah, so I'll stop you right there, actually, because you're jumping ahead a little bit, which is great. I'm glad you're thinking in a forward direction. But the first half of this, phase one, is the only part of the proposal that I'm indicating is almost ready to be wrapped up. And phase one is just 15-minute scheduling using the existing.
Hello? Hello? Hello?
Please stand by. We seem to be experiencing audio issues.
Hey, Lauren, can you hear us?
We can hear you.
I can hear you.
There we go. I'm back. Sorry about that. So what I was mentioning is the 15-minute scheduling piece of this is truly just to address 15-minute scheduling granularity using the existing day-ahead market structure. So the integrated forward market as we know it, the residual unit commitment as we know it, will be the same with 15-minute granularity. And that's the only part that I'm indicating is close to be wrapping up. So we're going through separate policy development phases and separate implementation phases based actually on the request from the majority of our stakeholders participating in this effort. The flexible ramping product still has a lot of room for discussion and development. So we're at the very, very early stages of developing the flexible ramping product, requirements, procurement, et cetera, as well as the day-ahead market formulation. George will be presenting slides later to explain how the day-ahead market will now be co-optimizing energy, AS, and FRP. So that's to come at later. So right now, in the morning portion, we're just going to be talking about 15-minute scheduling granularity.
Thank you for that clarification. Somewhere in the proposal, it was also mentioned that I believe RUC will be changing a role, and so I mean
that's again
still,
for phase two. RUC will not be changing with the exception of moving to 15-minute granularity for phase one. So changing the paradigm of what we use RUC for and how it's going to be used in the future will be a part of phase two, which includes the new day-ahead market formulation and the introduction of the flexible ramping product.
Okay, thank you. I still see them as all tied in, but and I didn't see any details and really the questions I asked. But I'll leave it at that, and I'll wait to see if some more detailed walkthrough is provided later. Thank you.
Thanks. So the 15-minute scheduling in the day-ahead market, the objective is to better position our fleet to be able to respond to real-time imbalances that occurs. A considerable benefit to moving to 15-minute scheduling granularity is the ability to utilize the Pacific Northwest Hydro, which right now is able to schedule into our day-ahead market, but has limited ability to respond to real-time market dispatches. The real-time 15-minute market responds with a 22.5-minute window, and the hydro fleet in the north has to set up their schedules well ahead of 22.5 minutes in advance. So while they do have flexibility with shaping their schedules, they have to have advanced notice of what the schedule would be. So moving to 15-minute granularity in the day-ahead market will better utilize the Pacific Northwest Hydro fleet. Similarly, for our variable energy resources, you think of solar ramping up in the morning and ramping down in the evening. We can have major solar ramps that occur within a single operating hour, and we actually have a figure in the phase one paper. It's at the very beginning. I don't have the figure number, but it shows actual data from our forecasting team explaining how dramatically those ramps occur within the hour. So if we allow our solar fleet and other renewables to be able to schedule with 15-minute granularity, we reduce the need to make up those granularity differences when we hit the real-time market. With this, we also will be able to ensure the day-ahead flexible ramping product when it is introduced with phase two in the fall of 2021 after this, that the purpose of the flexible ramping products will be to address uncertainty as opposed to address granularity differences between intervals. And the overall is that we'll be able to now commit resources to more accurately match our steep net load ramps and changes that occur within the hour. We do have technical challenges. We'll be transparent with that's the main reason you haven't heard much on phase one recently. Our technology team is working very diligently to ensure we can solve the market within the timelines we have set. And the main challenge from this arises because our market in the day-ahead time frame now, instead of solving for 24 one-hour intervals, we'll be solving 96 15-minute intervals. We are quadrupling the number of binary variables used in the market. And that's a very complex problem, and that's part of the reason our technology team has been working to make sure we can market. Additionally, there's a big uplift we know for all of our stakeholders as well as our internal settlements team. Our settlements will need to make changes to pretty much every single charge code we use today. So there's big uplift with implementing this. This is the content of what we'll discuss in the presentation. I numbered these intentionally because they correspond with the section number in the paper. So if you're looking at any of these sections and you want more information, it corresponds with the section number in the third revised draw proposal. You can always reference back to find more information if you need it. So today we'll be discussing 15-minute scheduling and bidding, our unit commitment process, the residual unit commitment process, scheduling options for interties, 15-minute scheduling coordinator trades, load meter submission options, AF bidding and scheduling, market power mitigation, ramping energy calculation modifications, demand response, a couple additional design features that don't fall into any of those main buckets, and then finally changes to the energy imbalance bucket. So with that, let's talk about 15-minute scheduling, I think our most straightforward piece, but also the most critical. So we are proposing to move the day-ahead market from solving in hourly granularity to 15-minute intervals. And this will provide significant operational benefits in being able to address granularity differences that occur within the hour. So this is actual data that we took. John, do you know what time frame this was from?
Like spring of last year. Spring of last year.
On the left axis, you see our schedules. The green line represents hourly schedules. The blue line represents 15-minute schedules. On the right axis, you see the ramp rate. Again, the green dotted line is the hourly ramp rate. The 15-minute dotted line is the blue dotted line is the 15-minute ramp rate. Right now, our market is solving from the midpoint of hour 1 to midpoint of hour 2. However, you can see here in hour ending 17 that the scheduled change between the first two 15-minute intervals of the hour is significantly less than the scheduled change between the second two 15-minute intervals of the hour. And we see patterns like this frequently as we ramp up in the evening, as we ramp down in the evening. And what happens is even though our hourly market is solving with a ramp feasible solution between hours, our 15-minute ramp solution between 15-minute intervals is actually not feasible. So the ramp you need to go from one 15-minute interval to the next is actually less than what the hourly solved ramp was able to provide. This is a big operational challenge, and it's actually one of the drivers that our operators have claimed the need to do the imbalance conforming process, also known as biasing, in both the day-ahead market through the residual unit commitment process and in the real-time market. So by moving to 15-minute scheduling granularity, we'll make sure we have ramp-feasible solutions between 15-minute intervals, which should reduce the need for our operators to bias in the day-ahead and the real-time market. Design feature 2 is 15-minute bidding. If you think back to about a year ago this time, we originally came out with a proposal to maintain hourly bidding, and based on feedback from stakeholders, we agreed to implement 15-minute bidding in addition to 15-minute scheduling. This will apply to all market participants, load, imports, exports, gen, virtual supply, and demand. And by using 15-minute bidding, we're eliminating the need to use upper economic limits and forecasts to shape hourly bids. One of the benefits from this is that variable energy resources, again, think of a solar unit, will no longer have to set an upper economic limit and instead can shape their schedule for each 15 minutes. Additionally, load can shape their demand by submitting different 15-minute intervals, as can proxy demand resources to reflect underlying load that may change within every 15-minute interval. In addition to the bidding submission granularity, we wanted to talk about the bid submission deadlines. Right now, the bid submission deadline for our day-ahead market is 10 a.m. every day. We will need an additional hour for the market to solve. So the last proposal, you'll recall, suggested moving the day-ahead bid submission deadline from 10 a.m. up to 9 a.m. We received feedback that that was not favorable to everyone, so we've tried to come to the middle, and instead of shifting it an entire hour, we're now proposing to shift it from 10 a.m. to 9:30 a.m., but corresponding to that, we'll also need to now publish the day-ahead market 30 minutes later. So instead of 1:30 p.m. or it's existing at 1 p.m. or 1300, and we'll be moving that to 1:30 p.m., which is 1330. And one of the other reasons for changing from 9 a.m., which was what the last proposal said, to now 9:30 is so we can capture real-time gas trades, which are used to update reference level adjustments. So there was an operational need for that as well. The scheduling coordinator will be able to submit a unique bid curve for each of the 96 15-minute intervals throughout the operating day. But I'll note the real-time market will be pulling bids at 75 minutes prior to the operating hour. So we won't be pulling 15-minute bids every 15-minute interval. The real-time bid submission will remain unchanged. So at T-minus 75, we'll be pulling all 4 15-minute interval bids, which may be unique, and pull those at one time. That greatly reduces the data push from our real-time market, or from cyber into our real-time market. Any questions on 15-minute scheduling or bidding? Great, we'll keep going. Oh, one question on the phone, we'll take it.
Good morning, this is Connie Dorland calling from the Public Advocate's Office. I had one question regarding the proposal. In general, it seems like it would reduce costs for ratepayers because you would procure less or procure the right amount of energy with the granularity proposal. But I'm curious, with the other products proposed, the flex ramping products, is it possible that ratepayers could pay more with this proposal?
I'm going to, if it's all right, save that question to our discussion of the flexible ramping product. I think that that question is better for phase 2 of our discussion, when we'll be getting into a lot higher level detail of what the flexible ramping product is, how it's procured, and what the requirement is for that, if that's all right.
This is Don. I would add that the 15-minute granularity itself is a benefit because it does allow additional supply that can provide load following from Pacific Northwest Hydro, because currently they can only follow load with hourly granularity because they need to set their systems up day ahead. If they can now load follow with 15-minute granularity, they can more closely meet that load following need. So it actually provides additional supply capability to meet load.
Okay. I'll look forward to the discussion on more specifics on the impact to ratepayers.
We have one question in the room. I'll take that next.
Hi, Steve Keene from Navigators. With the being able to submit 96 15-minute bids, are there any restrictions on how those bids can move around within an hour or anything?
No, obviously it'd have to be within the capabilities of the resource, but I would expect that scheduling coordinators would set up their bids and the market would be solving within the limitations of the unit characteristics that are defined in master file. Go ahead.
Hi, this is Mike Whitney with NCPA. Since there's going to be, 4 times as many bids, is there any kind of proposal to reduce the GMC for bidding? It's only half a penny, but I was just wondering, if that's been considered at all.
Keeping it the same.
So your concern is on the bid segment fee that's
correct.
We can take that one back and look at it. We didn't look at it, I think, for the same reason you said, that it's such a small cost, but we can take a look at it.
Yeah, we can take that one on the phone.
Hey, Lauren, could you please open up the lines?
Hi, this is Fang Wu from Guapang. I have a question, and after that, I want to share with you some of our concerns about this timeline. First, I wonder why you cannot, if you need 1 hour, why can't you publish market results at 2 instead of moving up the market close time 30 minutes? Just postpone another 30 minutes. Just from our business point of view, I don't know, maybe other participants care about that. We don't care if you postpone an hour, but if you move it up an hour, it causes a lot of trouble to us. So this is a question. So why?
Yeah, we actually have heard that postponing it can cause problems as well. There are day-ahead engineering studies, day-ahead checks, even doing RC functions rely on the output of the market publication timeline, and most of the day-ahead scheduling checks that occur between balancing authority areas are wrapped up by 1600. So for the purpose of day-ahead scheduling, that was one of the needs not to push the market solve time considerably later. So we're trying to balance the need between not solving any or having the bid submission deadline move any earlier, but also not moving the publication time any later. So this was the balance we thought was appropriate.
I see. So
can you speak up into the phone a little bit too? We're having a hard time hearing you.
So it seems my understanding is that the problem of postponing it causes trouble to the ISO process, or would this cause trouble to the whole market if you postpone it? Is it mainly the ISO process that needs more time, or this is, other market participant process that prevents you from postponing it for another 30 minutes?
A good question, and it's not just the ISO. We do run engineering studies, but right now Peak runs engineering studies as well, and intertie e-tagging that occurs for all balancing authority areas and requires all scheduling coordinators to take part in those activities. So the day-ahead activities are not limited to just the ISO.
Did you receive any comments from market participants that claim that, they need more time? They prefer you to move it up instead of postponing it.
So we did get some feedback that, for instance, it limits the amount of time to where a gas resource could go procure its gas in the day-ahead time frame for its day-ahead awards. But again, we're open to stakeholder comments with regarding to where you want to put the extra 30 minutes. I think we did believe that moving it early at the 9 o'clock, which we had previously proposed, we did in further discussions, it limits the accuracy of the gas price you could use to update the reference levels. So that's why we wanted to push it out so we could get more time to observe that. But if publishing it too doesn't cause business issues with stakeholders, we can definitely look at updating that in the draft final proposal.
Because if you move it up, it causes a lot of problems. Because people get up very early to come here to start a business. And there are labor issues as well. Because certain people come in during the day, other people come in 24/7. You push it too early, you change the nature of the job. So this is a huge cost probably to the market. It's besides the market design issue, it could get involved in labor issues. Now, that's a question, and I also want to share you with some other concerns. Very recently, the ISO changed the operating procedure. I believe it's 3640. In that procedure, the ISO, that new procedure would allow the ISO to consider transmission outage until 9 a.m. In the IM process. Before this most recent change, the transmission rating were locked in by 8 a.m. And if there is a reason to use transmission derate after 8 a.m., the ISO internally needs to go through an approval procedure. It's considered an exception. But the recent procedure change moved that deadline to 9 a.m. Okay. Now you're proposing to close the market at 9:30. So you're leaving only 30 minutes for market participants to reschedule. Potentially, they have to sell their position. You know, if there is a transmission delay, they made the bilateral deals already, and then they need to probably sell their position if they can. And this is a take-or-pay contract, some of them, right? And this is not real time, probably it's not force majeure, and then they're on the hook to pay for it. So if you don't leave enough time for people to adjust their schedule and manage their position, and there are serious problems. And the combination of the operating procedure and the new timeline just reduced 2-hour window to 30 minutes. So I hope the ISO, considers this, and, if in case you really have to move this timeline up to 9:30, probably you should also considering revising the operating procedure, 3640.
Yeah, I'm familiar with the operating procedure. I actually used to work that desk when I was an operator, and the reason for changing that timeline was to ensure that transmission outages that come in late, which forced transmission outages happen, there's no way to avoid them. But it's the best way. We want the transmission outage, if we know about it, to be able to make it into the market. I will say that it's not a regular occurrence. It's the anomaly. And from a market perspective, if we know about the outage, we'd rather get that outage into the market so the market can solve more accurately than know about the outage but not get it into the market. I do understand your point on having a shorter time period then to be able to update your bids and take a different position. So include that in your comments. I'll also note that we're talking a lot about the 9:30 start time, but not a lot about the 13:30 or potentially 400 publication time. So if there are stakeholders that are on the opposite end of this and need to get people out of the office at the end of the day, and that pushing the solve time or the publication time back an hour would cause conflicts, we need to know about that as well. I think, like Don mentioned, we're open to being flexible. We just know we need a 4-hour window for the market to solve, and we want to do what's best for all parties involved. So thank you for bringing up those comments.
Thank you.
And moving to the next question in the queue. Caller, your line is unmuted. You may ask your question.
Hello, y'all, this is Promote at PG&E. Just on this slide 14, just a minor point to clarify. The expectation is you've got a bid package of 4 unique 15-minute bids for each hour, real time, likewise day ahead. But the structure of, am I correct that the structure of the minimum load bids will just remain at hourly granularity in both of these cases? And also, am I correct that the gas price used by CAISO will not change within the 15 minutes in the intervals within an hour? That's the question. Thanks.
So I'm having a little hard time hearing you. There's some muffle on the phone, but I think your first question was about load bids, and the second question was about gas prices that the CAISO uses. Is that correct?
No, I'm sorry. Can you hear me now? Am I clear? I'm not.
That's a little bit better.
Excuse me, sorry. I was asking about minimum load costs, not load bids, minimum load costs. As part of the bid package for supply bids, you submit a startup cost and a minimum load cost. And I'm asking my assumption is that it's static for the hour, and likewise the gas price would be static for the hour. I just wanted to check that assumption.
Hi, Alva. This is George Angelidis. So with the support for 15-minute bid submission, for 15-minute, not 15-minute bid submission, but for 15-minute interval bids, the minimum load cost will also have the same granularity. You can submit it for each 15-minute interval to go along with your energy bid. We do have today the ability to receive startup cost bids as well at the same granularity, but of course there is the caveat that when the optimization horizon is using these bids, it's going to be fixed for the time horizon. So we will receive the first one that we'll see for the interval, and then for the day-ahead market will be for the entire day. But for the minimum load cost bid that you had the question specifically, that will have the 15-minute granularity as well.
Okay, well, that's very helpful, George. I didn't expect that. And as far as the CAISO's own gas price, will that be changing on a 15-minute granularity as well?
Don says no.
Okay, thank you very much.
But Alva, again, when you put...
Okay.
Sorry, what were you saying?
So it's safe to say that, Alva, right now we don't have a plan to update the gas price on a 15-minute basis. However, the system infrastructure, once it will be set to support 15-minute bid granularity, if in the future we want to entertain the possibility of having updates to the gas price on a 15-minute basis, that will be possible. But at this point, I don't think the data that we have supports this kind of granularity for gas prices.
Okay. The thing you want to think about there is that you're going to be validating your bid set on an hourly basis based on your submission deadline. So once you've validated it, if you change the gas price, you might affect the validity of the bids.
All right, you're referring for the real-time market, because in the day-ahead we just validate when the bid comes in for the entire day. Yeah, for real-time, yes. There might be an issue if the gas price really is volatile and changes real-time after we validate, and this we'll have to examine later on.
Okay.
See what we can do about it.
Thank you.
Great.
And there are currently no additional questions in the queue.
Okay, thank you. Go ahead. We have one question in the room.
Steve King, can I follow up on what you said before? The bids are going to be in 15-minute intervals. You can submit them in 15-minute granularity, but as I recall from the other parts, the commitment process is still an hourly commitment process.
Good segue.
Have you looked into whether that would, is that potentially going to cause any issues?
So this is a compromise that we're considering to achieve the performance that we need to deal with the fact that essentially the variable space of the problem is quadrupled, and because it's, I don't know if you are familiar with these kind of problems we're solving, there's a certain combinatoric nature into it, so you may quadruple the variables, but that doesn't mean that you quadruple effort. Because your solution space moves exponentially with that. So to come up with some reasonable performance to be able to solve in those 4 hours that we want to allocate for the market to solve, one of the compromise that we were considering and we're proposing here is to, in the day-ahead market, although you will have an optimal 15-minute schedule calculated, we will limit the commitment decisions at the hourly boundaries. And for short start units and medium start units that could be reoptimized in the real-time market, if the participant does not self-schedule in real time but allows the unit to be reoptimized in real time, doesn't have any answer, self provision, or this kind of things, the real-time market could, the FMM, could actually refine on that commitment on a 15-minute basis. So initially you start with an hourly commitment to address the dimensionality and complexity of the problem, but as you move to real time, you'll be able to refine on that solution.
Yeah, my question was slightly different. It was just, are there any issues that come about because you're doing the commitment on an hourly basis, but you have 15-minute bids?
No, we don't see any issues because, as you know, the day-ahead market has an objective function, which is the entire cost over the day, over the daily market horizon. So in there you have the cost for all your commodities on a 15-minute basis, plus your commitment costs that may occur on the hourly boundary. So we don't see any problem.
This is Mike Castellano, DMM. I guess two questions. One, going from what Steve was saying, so if you're only going to be committing I'm assuming on the hour, right? You're going to be committing and decommitting on the hour. So what goes on with virtual bids? Are you thinking 15 minutes for virtuals?
So virtual bids, they don't have any physical characteristics like intertemporal constraints and things like that.
Right,
so
right. So
they really can be scheduled on and off on any 15-minute interval. There's no restriction.
Okay, and so they'll have 15-minute bidding granularity?
Yeah, this is the same for everybody.
Because there is a little, so like in the morning ramp, you're going to be committing resources for, say, the second half of the hour. You're going to commit what you need for the second half of the hour at the beginning of the hour. So you'll kind of have a situation where you might be able to reliably predict that, say, day-ahead interval 1 prices for some period of the day are going to tend to be more, or are going to tend to be lower than real-time interval 1 prices for that same interval because of the hourly nature of the commitment, and then sort of the opposite for interval 4, right? The day ahead is potentially going to be higher. So, I mean, maybe I'll just take that and start my own business, but...
Well, Mike, we would appreciate if you could give us comments and maybe examples of what you're referring to. What I can say, and what I think Megan has already said, by introducing a 15-minute granularity, we'll be able to shape our supply schedules closer to how the demand is moving. Having a commitment on the top of the hour maybe is not perfect, but is what we can possibly target for implementation at this point in time.
So that's actually just my second question. I know you guys have looked at this a lot. Has the ISO actually come up with a number of like what it would cost in computing resources to solve in a 15-minute commitment?
Sorry, I didn't understand that question.
Have you guys looked at what you would have to, I mean, this problem could be solved, 15-minute commitment in probably 2 or 3 hours if you really wanted to spend enough money on computing power, right? So
no,
given the...
Mike, currently at this point we can't solve it with 15-minute unit commitment. We tried, it just doesn't solve with what we have available right now.
Well, yeah, but so the question is, what more could become available with additional expenditure to solve it on a 15-minute basis, on 15-minute granularity?
Mike, you're assuming that we can spend whatever money we can afford to buy better hardware to solve this problem, because when I say it's unsolvable at this point, is with the best hardware that we have available. So it's not, at this point, the technology ability is restricted. We can't get to that level. I can't speak about the years to come, but at this point, we cannot solve this problem.
Okay.
It's not a money issue. I don't know how can I describe this.
Okay. I don't understand how that would be the case, but all right.
Why don't you stop by and I'll show you?
Actually, I know we've got a couple more questions in the room and a couple questions on the phone line, but let me at least hit the content of this slide because I'm assuming the questions at this point are about the commitment process. So I want to at least go through the process and explain where we're at and why we're here, and then we'll take the questions. So the reason we have waited a considerable amount of time since our previous proposal was to allow technology to go through multiple iterations of simulations to figure out what our options are for solving the market in 4 hours, as George mentioned. So optimally, we would have preferred to have 15-minute unit commitment, match the 15-minute scheduling and bidding granularity. As George mentioned, that wasn't solvable at all. So the next solution, option 2 here, which is listed on the slide, was to have 15-minute unit commitment for our fast start resources. So any resource that could start up under an hour, and in addition, your MSG, your multi-stage generator transitions, could occur on any 15-minute interval, and then your longer start resources or your medium start resources would continue to have hourly commitment. We were not able to achieve a solve time that was within 4 hours for that either. So now we are to the last solution, which would be hourly commitment for everything. That includes your multi-stage generator transitions. but you will have 15-minute scheduling so we can shape intervals within the hour. And as George mentioned, we went through this process, and the main complexity was the quadruple binary variables that are used in the market based on having 4 different intervals within the hour. So that's the background on this. We will, in the draft final proposal, have additional information. I know this is pretty much all the paper says right now, and Khaled Abdul-Rahman, who's our executive director, has been working with George on this, will actually attend the next meeting to provide some additional details and insight on this. So with that, now let's open it back up to questions on the commitment process granularity. Go ahead, Carrie.
Carrie Bentley with the Western Power Trading Forum. So I just wanted to make sure I understood Mike's point, because I thought if you had, if you're just doing hourly commitment, it's very similar to the real-time market, right? I mean, even though you have an hourly min load cost and you have startup cost, essentially that's just integrated into multi-interval optimization. So you don't get this clunky increase of cost in the first part of the hour and then a decrease in cost in the second part. But it sounded like, Mike, you had a different opinion. So I was wondering if you could just describe that a little bit more, because I wasn't understanding.
You mean what I was saying about virtuals?
Yeah.
Thing? Okay. So given that you'll have hourly commitments, so you might need to commit a resource that you're not going to need to ramp up until the second half of the hour. And that it's not a certainty, but it could cause prices in the first half of the hour to be a little bit lower, and in the second half of the hour maybe or maybe not be a little bit higher, because you're going to tend to be ramping into the higher ranges of whatever you have committed at certain parts of the day. So it could, depending on how things played out, it could potentially be, you could have a pretty easy virtual situation there where you sell, or what you buy in the first half of the hour and sell in the second half of the hour in day ahead.
So I just, my off-the-cuff opinion, the optimization is pretty clunky anyway due to different resource constraints. You have min up times and min down times, and that means you're not always perfectly committing the resource in the exact hour you first need it. So I would think unless, maybe in the future when we have a perfectly flexible fleet and it's all storage and wind and solar, yeah, that would be a great virtual game. But I think now when we still have a lot of gas resources, I don't think that will be an issue.
This is Don. I would point out that the virtuals are arbitraging between the day-ahead 15-minute interval and the real-time 15-minute interval. They're not arbitraging between the first part of the hour and the second part of the hour in the same market.
This is Tyson Brown with PG&E. So in our comments on both the deadline change, we had asked for some sort of data or an actual demonstration that you can hit the solve times. And so what you've described here and the way that I read it in the paper was you got to your bullet 3 through process of elimination. We couldn't do 1, we couldn't do 2, so 3 is the only option. So have you gotten results that prove to your satisfaction that you can solve within the deadlines with the increased load of all the bids?
So that is exactly what we're trying to do here to be responsive to that. We are still in the process of doing the technical evaluation, gotcha. And that's why in the draft final proposal, that's where we would provide that assurance.
Okay.
And then again, the assurance is, do you really need the hour? And don't come back and ask me for more time than an hour. So we've been still.
Right. Well, yeah, I'm thinking about it slightly differently. I'm fine giving you the extra hour and moving all of our processes around, having people stay later for the submission, but I want to know that it's going to work, right, and then it's worth it and that we get the results that we want.
Absolutely. My hope actually was that George and Khaled would be able to speak to that today, but they're literally working on it right now as we speak. So we decided we'd rather come to you guys with concrete information than, well, this is what we think it is, but we're still fine-tuning the details. So we will absolutely have concrete information by the time we come back in mid-April with the draft final.
I mean, I would note that to me is what's gating whether we put a draft final proposal out.
Yeah, let's put it this way. If we do not have that confirmation, we will not publish a draft final proposal. That really is what the draft final proposal is hinging on. Yeah, go ahead, George.
So what I said earlier, I want to make sure that it's understood. When I said we cannot solve the problem, with full unit commitment on a 15-minute basis, amended the problem that we have today without dumbing it down. If we start unbundling and throwing out features that are part of our market today, which we consider important features that we want to keep, and the most important item that comes to my mind right now is the dynamic ramping functionality that we have in our market since MRTU. That is a very important functionality that we want to keep. And it imposes a large performance requirement to the market engine. And we tried it, so we know, if we remove the dynamic ramp functionality and we have to solve the problem with static ramps, we wouldn't be here at all. We can solve this problem. That's not a problem. But our target is to go to a 15-minute granularity without sacrificing anything of all the features that we have implemented in our market throughout the year. And that is a very hard problem to solve.
Hey, this is Mike Castellano, DMM. I definitely wouldn't think that you guys would entertain that, George. I just was curious. It seems like you're talking about not quite having the computing power to do this whole optimization through the entire solution space that you have in 4 hours. And it seems like, I was just curious, have you looked at what type of computing power it may take to be able to solve that and what that would cost? And maybe it's some crazy amount of money and it would not be feasible, but maybe, given the benefits we're potentially talking about here, seems like you could spend a lot of money and it would still be worth doing potentially.
Okay, so I will repeat this again now, Mike, so it wasn't clear the first time. The solution that you're trying to achieve is not necessarily achievable by having a larger computer power, spending more money, okay? Even having a supercomputer at the basement does not guarantee us that we can solve this problem with existing technology. We're using solvers that are designed to solve big problems, but this pushes the limit in a direction that we cannot guarantee at this point by any kind of certainty a robust solution to be contained within the 4-hour window, even if we throw more money and more computer hardware into trying to solve this problem. This is a problem of a theoretical nature. It has limitations that go beyond the existing level of technology.
Thanks, operator. You can open the lines now.
And we do have a question in the queue. Caller, your line is unmuted. You may ask your question.
Good morning. This is Gong Nguyen with Future Style Energy. Can you hear me well?
Yes, we can hear you.
Thank you. First off, thank you for bringing forward this presentation and proposal. I was very excited the first time, even in the last iteration when the ISO said that they could do 15-minute unit commitment. But I recognize that there are a lot of challenges in terms of the technical space. But I do have some concerns here with regard to the commitment and the scheduling. Now, the commitment now will be done on the hourly basis, but scheduling will be done on a 15-minute basis. So if we need the unit only from minute 45, we really have to turn on the unit from the top of the hour. And so the concern is what's happening in the first 45 minutes of that hour. So when it goes to scheduling, more likely it will dispatch the unit at premium, which depress the prices in those 3 intervals. Before I get to the final interval of the hour where, okay, commitment is right, it should be commitment of the unit should be made, and the unit now is following economy. So that is where I see the discrepancies between the unit commitment, which is done on the boundary of the hour, versus the scheduling, which now is being done on a 15-minute basis. So that will may potentially create uplift in the market and the inefficiency of the market. certainly we still see benefit, but really the differences between the commitment and the scheduling now will discount a lot of that benefit, I think.
Okay, so today we have hourly unit commitment and hourly scheduling. All right, keeping the hourly unit commitment and moving to 15-minute scheduling, we have an immediate benefit. All right, that will be a reduction to the costs of the system. So we're moving in the right direction. Yes, we're not going all the way, but it's a benefit. I hear a lot of comments here that this will create problems. We're solving problems by going to 15-minute scheduling. Yes, we will solve more problems going to 15-minute unit commitment. I think there is an issue with the hourly unit commitment that your P-min level of committed units have a lumpy nature, so that will come in at the top of the hour. But you have to keep in mind that we also now have 15-minute scheduling of the Northern Hydro resources on as inputs, so you have more tools to equilibrate and balance this lumpy energy that will come in as units are committed at the top of the hour. So you have to see the whole picture. Don't get stuck up on the hourly unit commitment. This happens with 15-minute scheduling. So it's better overall. I think we're getting hung up on the fact that we're not proceeding on a 15-minute unit commitment, but don't lose the sight that the 15-minute scheduling is a very big benefit overall.
Thank you, Joe. I think you hit the point. I'm not saying that it doesn't benefit, but the fact that you cannot do item 1 and 2, it will discount a lot of original benefits that the previous proposal was brought up. So that's all I'm saying. But my next question is what is going to do with the short start units then? If the short start units now, so how, I just want to understand today's market, when do you even commit the short start unit in the day ahead market, or do you rely on the real time to do the commitment of the short start unit?
So, as I said earlier, everything is going to be committed on an hourly basis, all resources, long start and short start resources. The advantage of the short start resources is that they would be re-optimized in the 15-minute market, so unless they self-schedule in the real time, they will be available for re-optimization in real time. We can move the commitment from the hourly boundary to within the hour as needed. So you have that advantage still. So you can see the hourly unit commitment as a preliminary commitment for the short start units day ahead, but it will be potentially refined in real time.
And I'll add that the timeline George was talking about is our stuck timeline, which runs approximately 4 hours in advance of RTD. So any resource that has a startup or shutdown time within the 4-hour time horizon can be re-optimized and therefore committed or decommitted through the stuck process at the beginning of any 15-minute interval, and that's functionality that exists today.
Thank you. Okay, the bottom line is that the short start units still take the financial position from the day-ahead market then.
Yes, they get a financial position in the day-ahead market.
All right. My next question is about the point you tried to make. The Pacific Northwest Hydro Resources can provide 15-minute schedule in the day-ahead market, but not in real time. I'm not sure if it is correct for all the hydro resources in the Pacific Northwest. We don't see that in our system. So maybe this has to be a little bit more specific because
so we agree that it's not all hydro resources in the Pacific Northwest, but we have had conversations with BPA that they have significantly more load following capability than they can provide if they provide in real time than what they could provide day ahead.
Okay, so maybe you need a little bit more clarity here, say BPA Hydro, not everybody else if they don't have that problem. So that's the only comment I have. And thank you.
So Paul Gribick from PG&E. I just wanted to make a bit of a comment about all this stuff about starting all of your units at the beginning of the hour, where maybe I have a raft of relatively small fast start units that I could have started across the hour. You know, I can end up turning on them all because I'll need them all at the end of the hour. And as they were saying, you can push a lot of those resources down to P-min, which means I'm going to be backing down cheaper resources in those periods, and I will depress my prices at the beginning of the hour in the first intervals. That could be a problem. I don't know how big a problem that would be. I think it's something we should keep an eye on as we're going into this during the test phases. Because you know, as I depress those prices, I'm going to give those units BCR. Now, what happens when I go to real time if I re-optimize my commitment? Are those units going to have to disgorge the BCR, you know, or will they get paid BCR, and then whenever they're turned on or turned off, they get to buy back their schedule? You know, so I think we have to look at what profit incentives we're giving here. This is not just minimizing cost. You're affecting the prices. That affects the incentives in the market. I was saying, I think that that's something worthy of tracking, worthy of studies for doing this. I don't know if it's going to be a problem. Potentially it would be, conceivably it could be, but I don't know how likely it is. That's all I wanted to say on that.
Thanks, Paul. I do believe we have a couple more questions in the queue.
Yes, and we're opening up the call for the next caller in line. Caller, your line is unmuted. You may ask your question.
Hi, this is Alva Stewart at PG&E. Sort of a follow-up on a number of the points raised earlier is just, and it's sort of along the lines of the way Paul phrased it, there's necessary to keep an eye on the issue of potential strategic behavior with respect to to minimum load costs in terms of how they're bid across the hour, because it does sort of sound like it would be possible, for example, to understate your costs in such a way that you'd get artificial BCR due to your bid, and that isn't necessarily just short start units, but other units that are being used differentially across the hour. So it does sort of sound reminiscent of some strategic behavior that's occurred in the past, and I'm sure the DMM will keep an eye on that, but it's worth looking at in testing and making sure if there are ways of addressing it, that we're aware of that going into the go live of this. Thank you.
And we're moving to the next question in the queue. Caller, your line is unmuted. You may ask your question.
Hi, this is Gil Sanford with Utilocast. I apologize because this is going back a ways in the discussion, but to return to the earlier questions regarding the ability to now submit bids for each 15-minute interval, I recognize that has a helpful use in the real-time market with its existing 15-minute granular unit commitment. I'm struggling to piece that together, its utilization of, say, a startup cost for a mid-hour 15-minute interval and the day-ahead market, given the top-of-the-hour unit commitment timing. If I understand the use of startup cost bids correctly, it would seem to me that a mid-hour startup cost bid would have no meaning in the day-ahead market.
Yeah, I think the issue you're bringing is not with respect to the startup cost. That's a commitment cost, and it's for the entire day in the day-ahead market. I think your issue is that you don't see value, perhaps, in having energy bids, let's say, being different for different 15-minute intervals of the hour. Did I understand?
No, sorry. So it may be just a mix-up in my understanding. I thought that the unit commitment, as was described earlier this morning, essentially locks in, say, when it's making a unit commitment decision, locks in on the min load cost bid and the startup cost bid for the particular commitment interval. Is that correct or not correct?
Well, the startup cost is one value for the entire trading day in the day-ahead market, but the minimum load cost could have different values for each 15-minute interval. And when you commit a resource that, let's say, has to run for an hour, then the four minimum load costs for the four intervals of that hour become part of the objective function evaluation, whether this cost is justifying to start up the resource. So there's a difference.
Okay.
The minimum load cost has. Do you still see, I mean, your original comment seemed to be questioning why we're allowing 15-minute granularity on the bids.
No, I think you've answered it. Yeah, it was essentially whether the commitment engine would ever take into consideration the mid-hour commitment-related bids, and I think you've answered it. Thank you.
And there are currently no additional questions in the queue.
All right. We'll proceed forward. Design Feature 4, the Residual Unit Commitment Process, also known as RUC. So the Residual Unit Commitment Process currently occurs after the completion of the integrated forward market. They occur sequentially, and the purpose of the Residual Unit Commitment Process is to commit or schedule additional capacity if needed to match the ISO's net demand forecast. So this will have to move from the existing hourly process to 15-minute granularity to match the 15-minute granularity that will occur in the integrated forward market. We will also move the intermittent adjustment process, which is used today in case VERS, variable energy resources, are not scheduling into the day-ahead market, but we anticipate they will materialize in real time. We don't want to overcommit other supply resources, so we use the intermittent adjustment process. That will need to move to 15-minute granularity as well. I have this third bullet on here because at one point in time we had a discussion about the potential for RUC to decommit. We did do some studies and talk with our operators, and the need for RUC to decommit is not as much of a problem as it used to be, so we will continue for the time being to only allow RUC to commit additional supply as opposed to decommit. And it's very important to note here that RUC right now, this is really just an interim phase. So we will continue to maintain the paradigm of RUC as it is today through phase 1 with 15-minute granularity, but with the implementation of phase 2 in the fall of 2021, it's going to change. We're going to repurpose RUC as we use it today. And Elliot will be talking about that later. So just keep that in mind, that moving to 15-minute residual unit commitment as we know it today really will just be between the fall of 2020 and the fall of 2021.
Question? Over here.
Oh, yes, go ahead.
Andrew Meditz with SMUD. Can you, the second bullet, why is it just for under-scheduling issues, not over-scheduling?
That's a good question. So right now, it historically was more of a problem than it is today, but the ISO was noticing that most of our VERS were not scheduling into the day-ahead market. They were only scheduling into the real-time market. So what would happen is when the day-ahead market was running, it was committing supply to match what the demand was. But then when real-time materialized, all of a sudden you had a huge surplus of supply due to VERS bidding into the real-time market. So because we recognized that problem, we introduced the intermittent adjustment process, which is just a way of saying, yes, we know we have a ton of solar, and not all of the solar bid into the day-ahead market, but we're anticipating it will show up in the real time, so we don't commit as much supply through the RUC process because we anticipate the solar will materialize time. So it's truly a way to make sure we don't have an oversupply situation in real time when the solar shows up.
Okay, I think I understood that, but That's okay.
I've got a write-up of it in the paper, too.
Yeah, it's my fault. I'm just not as familiar with this, so thank you.
Yeah, check out the paper. If you have follow-up questions, let me know. Go ahead, Carrie.
Carrie Bentley with the Western Power Trading Forum, and I apologize. I think you might have gone over this a little bit earlier. It sounded like you were saying there'd be less RUC biasing because of this new process, because it'll be 15 minutes. It'll more optimally match what the operators think. So this is one of the big benefits.
Yeah, that's absolutely a hope that by having 15-minute scheduling and therefore 15-minute ramp feasible solutions, that our operators won't need to bias as heavily in the residual unit commitment process. I'll note on biasing in general that we're making major efforts. This also actually with the Imbalance Conformance Enhancements initiative that last year, but we're trying to address why our operators are biasing and figure out market solutions to minimize the need to bias as much in both the day ahead and the real-time market. The granularity is absolutely a piece and a benefit, but the flexible ramping product will be an even greater and incremental benefit on top of the 15-minute scheduling. So thanks, Carrie.
Yeah, we really appreciate that. And then a quick, just to make sure.
Carrie, can I just want to add to it. So, I mean, it gets back, it's sort of the other position to where we talk about the problems of having the hourly commitment at the start of the hour, but it also now gets that commitment into the market to where now they're doing it after the market through RUC, committing additional supply so that it's available to hit the fourth interval ramping hour. So, you know, yes, there's negatives in terms of that you may, by having a P-min burden in the first half of the hour, you've at least now got that commitment decision that previously was done out of market, in market.
Thanks. Yeah, obviously WPTF really appreciates that on the proposal, so I wanted to make sure everyone knew how great this was. So then my other quick question, I know, I'm sorry we ask this all the time, just confirming 15-minute RUC offers now too for the non-RA resources?
Yeah, availability bids? Mm-hmm. Yes, would be 15-minute as well. I'll make sure I add that to the next paper.
Yeah, I don't think it was in this paper.
It's not in there.
Yeah, thanks.
I'll also note, I'm glad you brought that up, at the very end of the phase one portion of this presentation, I have a note. We have like an additional design feature section where we're trying to think of anything that is hourly that needs to explicitly be said is moving to 15 minutes. If there is something that we have not captured in the paper or the presentation, please bring it up. That's really what we're looking for right now, is if there's anything else that's out there that we need to consider, we need to think about, now is the time to bring that up. So I'm glad you mentioned that, Carrie. Any other questions in the room? Operator, anything on the phone?
There are currently no additional questions in the queue.
Thank you. So on to intertie scheduling. So today our intertie imports and exports are scheduled on an hourly basis in the day-ahead market, and then have the flexibility to schedule as a 15-minute dispatchable resource in the real-time market. We're now going to allow interties both in the import and the export direction to schedule hourly or as a 15-minute resource in the day-ahead market as well. What's important to note is we will not allow the ability to change the bid type between markets. So if you bid into the day-ahead market as an hourly block resource, that bid selection will follow through and continue into the real-time market. Vice versa, if you say or bid as a 15-minute dispatchable import in the day-ahead market, you will also be 15-minute dispatchable in the real-time market. The second two or three bullets of the bottom half of this slide explain self-scheduling options. Let's say you have flexibility to have 15-minute granularity in the day-ahead market, but you do not have flexibility to be 15-minute dispatchable and respond to the 15-minute market changes in the real-time time frame. So a good example is going to be the BPA hydro. We know they can shape on a 15-minute basis in the day-ahead market when they have advance notice, but when they real-time, they can't respond to real-time dispatches. So the option for the BPA hydro fleet would be to economically bid with 15-minute granularity into the day-ahead market and then self-schedule into the real-time market. And that will allow those 15-minute schedules to stay constant and not change in the real-time market. You could also do the opposite by self-scheduling in the day-ahead market as a 15-minute dispatchable resource, but have the same value for each interval of the hour and do that as a self-schedule in the day ahead, that will result in effectively an hourly block, but then elect to be 15-minute dispatchable and economic in the real-time market. So those are options. I'm happy to talk intertie scheduling if anyone wants to know more options of how to do this or how to bid in based on your needs, but this should cover as far as intertie scheduling goes. I did receive a question offline about self-scheduling, so I wanted to make it explicitly clear that you will be able to self-schedule either an hourly block or a 15-minute dispatchable schedule in the day-ahead time frame. So self-scheduling is their bid election. Any question on intertie scheduling? Carrie.
Carrie Bentley with the Western Power Trading Forum. So if you bid in an hourly block, that means both your schedule and your bid price are locked for the hour?
Actually, that's a good question. I hadn't thought about that. So I was thinking that the self-schedule refers to just the schedule, but I suppose you could change your bid within the hour, but I think I need to take that back and think on that more. Because if you elect an hourly block schedule, it may be more appropriate to have an hourly bid for that as well. So I'll take a note on that. George, do you have anything to add on that?
Yeah. So if you want to participate as an hourly resource, based on the designation, which for every resource that is registered, we will use the master file designation. For intertie transactions, because they're not registered, we have to use the dispatch option that is available for the bid. It's used for real time. We'll make it just available for the day ahead bid as well. So once you designate that the resource is going to participate on an hourly basis, we will have a constraint in the market so that your schedule is flat across the hour. But that doesn't necessarily require the same bid for all 15-minute intervals in the hour. You can submit the same bid, of course, but it's not a necessary thing, and we won't have a validation to force that. You can actually have different bids for the 15-minute intervals. The constraint will basically make sure that the outcome of the market will be a flat schedule for. Okay.
And I suppose that being said, your hourly block schedule obviously then would only clear if you're economic on the average of those 4 intervals.
Yeah, that's why I was asking, because it's odd because you can't respond to those price signals.
Right.
So, yeah.
Yeah, good note. I'll make sure we add some clarification around that in the paper. Thank you. Anything else in the room? Go ahead.
Steve Keene, Navigant. Can I just follow up on that? So if you submit a block schedule, is it going to make sure that you're in the money on average across all 4, or do you have to be in the money in each one?
On average.
Yeah, it's the entire cost that matters. So.
Okay.
Yeah, and a good opportunity to note, if you have not been following the Intertie Deviation Settlement Initiative, which is fine, we talked a lot about the difference between an hourly block schedule and 15-minute settlement. So with FERC 764, this is just background info, we allow hourly block schedules, which ensures the schedule is going to stay the same throughout the hour, but we settle now every 15 minutes. We no longer settle on hourly prices, so the settlement may change on each 15-minute interval. Good note. Yes.
It's Carrie Bentley. Sorry, my battery ran out before, but so I was going to note that for bid cost recovery, if you do allow different bids for each 15 minutes, I think then when you do your BCR calculation, you're going to have to use those bids.
Yeah,
so,
of course
yeah,
we will.
And I don't know if you want that outcome. So that's why I don't think it's just as obvious to say it's fine to use 15-minute offers when you're requiring a block hourly schedule, and that's definitely something I think.
Kari, we don't see a problem with that, but if you see a problem with that, please put it in your comments. But right now, first evaluation we did of this, we didn't see any problem.
Did you check the BCR? I don't think there's a market problem. I think there's probably a BCR problem. I don't know if I'm going to have time to work up an example because we have comments due on this, Part 2 and RA in a couple weeks, but maybe. Right. I'll just put it out there. I think there is a BCR problem with this one, and you could game BCR. Maybe that's a DMM issue.
Well, I'll look into it a little bit more. Anything else in the room? Operator, any questions on the phone?
Yes, we do have questions on the line. Caller, your line is unmuted. You may ask your question.
Hello, this is Alvis Gavot at PG&E. I just, going back to the first principles here, because it's sort of obvious that, you know, market participants can create one energy bid that's at an hourly granularity and another at a 15-minute granularity, and then move energy between those, between day ahead and real time to some extent. And you discuss trying to prevent that kind of behavior. But could you just sort of go a bit more into what's the rationale for this rule? I mean, it's called a design feature. What is it you're actually trying to do by requiring this election?
The market needs to know if the schedule is going to remain constant over the hour or it's going to have the flexibility to respond to a 15-minute dispatch. So we have to, through the bid, tell the market what type of flexibility the resource has. And previously, we required all of that information to go into the master file, but as George mentioned, when we moved away from system resources as registered in the master file, we now allow real-time bids that aren't registered in the master file, and if those only have the limitation of responding as an hourly block, the market needs to be aware of that.
Well, I understand the idea that you might want to bid it. I understand the idea that you might want to bid in an hourly block and get an hourly block result, but why wouldn't you be able to change to 15-minute granularity in real time?
So I would, this is Don. So Alva, I think if you are actually 15-minute dispatchable in real time, we would want you to also make yourself 15-minute dispatchable in the day-ahead time frame. I don't know why you would not make that available, given that you can actually be re-optimized in real time.
I mean, I can imagine situations where because of your planning, you don't feel you can plan on a 15-minute granular. I mean, I'm not trying to make the case for it. I'm just trying to understand what the case against it is. But I could imagine situations where somebody would feel they can only plan on an hourly granularity day ahead. Once they get to real time, they know more about what they can offer, and they are going to offer on a 15-minute granularity. And I expect that will happen anyway. Just trying to get an idea of what it is you're trying to prevent. That's all.
Yeah, I'll take a note to look into that a little bit more. I'm trying to think of like the processing of all of our systems, the bids going into cyber, being fed into the market, and the market solving. And it honestly may just be a complexity in the bids being submitted in the day-ahead time frame, and then having that system resource or that transaction ID registered as one biddable type of product, and then the market being able to recognize whether that changed or not, and how would that change happen, and how would the market receive that information. So it truly may be more of a system complexity, but I will look into that and try to get more of a concrete answer.
That would be great. Thank you very much.
And we do have an additional question in the queue. Caller, your line is unmuted. You may ask your question.
Hi, this is Gwen again with Puget Sound Energy. My question is on the last two items. Could you please explain a little bit more so I have a better appreciation of what you're trying to do here? They cannot be scheduled in real-time market. I don't know what it does mean by cannot be scheduled, but then you can still self-schedule in the day-ahead market, things like that. I just have a hard time understanding what you're trying to say here.
So this is scheduling options if you want to change your flexibility between the day-ahead and real-time market. So under the preface that you have to stay either hourly block in day-ahead and real-time, or you have to be 15-minute flexible in day-ahead and real-time. That's your foundation. But if you need to change your flexibility between the day-ahead and real-time, you can use our self-scheduling option. So this last bullet is saying you want to have a hourly day-ahead schedule. You want to stay at 100 megawatts for the hour without moving around at all. But in real time, you can respond to real-time dispatches. You would have to bid into the market, both day-ahead and real-time, as a 15-minute dispatchable option or bid type, but in order to keep your schedule flat across all 4 intervals of the hour in the day-ahead market, you would need to self-schedule those 4 intervals. So these it's actually the last 2 bullets are just saying that you can use the self-scheduling option to shape your bid or actually hold your bid constant or your schedule constant across the hour based on the flexibility or inflexibility of your resource.
Okay, so can I just show up in real time but not day-ahead market?
Yes.
Yes, that's still there. Okay, thank you.
Unless you have a resource adequacy obligation, of course.
Good caveat, George. All right, inter-SC trades. Currently, inter-scheduling coordinator trades are done hourly, and they have to be submitted 45 minutes prior to the start of the operating hour. We will now be able to move this to a 15-minute basis. Inter-scheduling coordinator trades that occur in the day-ahead time frame will have no timeline change to when the scheduling coordinator trade must be submitted, but we will allow 15-minute trades within the day-ahead market. For real-time, we are proposing to allow the inter-SC trade to be on a 15-minute interval basis, and it has to be submitted 45 minutes prior to the start of each interval. So you could elect to do an hourly trade and have each 4 of the 15-minute intervals of the hour be submitted at T-minus 45, or you could do it more on a rolling basis. For 45 minutes prior to the start of every interval, submit the trade. We do think, and we've heard from scheduling or market participants, that this will allow variable energy resources to have a forecast that closer follows the actual flow and use that to create the SU trade, so we believe there's benefit to this. I'll note also that the GMC for the inter-SC trade is currently at $1, so we're dividing that by 4, and the inter-SC trade GMC will now be 25. So load meter submission, we are not making it a requirement that a load meter submission has to occur on a 15-minute basis. We understand some entities have 15-minute meters, some entities have hourly meters, and we're not making it a requirement that all load be submitted on a 15-minute basis. So there's 3 scenarios that could occur.
So we should be clear, we're not requiring 15-minute load meters. We are actually requiring it to be submitted.
Thank you. Yes, we're not requiring 15 load meters, but you have to submit data. So if you have all 15-minute meters, that data will come across to us, and we will flag it as actual meter data. If you have all hourly, it will come to us through your submission, and then we will calculate through a linear interpolation to determine what the 15-minute meter data would be, and that's described at the bottom of this slide. The 7.5 minute is the midpoint of the 15-minute. If you have a mix of 15-minute meters and hourly meters, we will submit that, or we'll take all that data as an hourly submission and then do the linear interpolation to figure out the 15-minute meter data. So we're leaving this flexible, but we do want our settlement systems to be able to recognize, is it true 15-minute meter data or is it calculated 15-minute data? And the submission type will help us determine that. Any questions on the last 2 slides? All right. AS, ancillary services. So we are proposing moving forward to procure AS for every 15-minute interval in both the day-ahead and the real-time market. Right now, AS is procured hourly in the real-time market. Our tariff, Appendix K, already states that both spin and non-spin are required to sustain output for 30 minutes. And this applies even if there's no AS scheduled for the subsequent 15-minute interval. So this is how it works today. We're just adding this as a clarifying note. So that means even if you have an AS award and you're called on for AS, you have to be able to continue generating for the next 15-minute interval, even if there's no AS scheduled for that corresponding interval. So that's not new. That's just a clarification. We have a note here about NGR, non-generator resources. The regulation for these has to be supported by a state of charge of supporting 30 minutes of dispatch and 15 minutes of charging. So currently our regulation up and down for NGR must be supported by the state of charge equal to the hourly duration of the award. Going forward, just for regulation up, because regulation up can cascade to a spinning reserve, you have to be able to dispatch for 30 minutes. However, regulation down cannot cascade to other ancillary service products, and therefore we will only require 15 minutes of charge for regulation down on NGRs. AS on the interties going forward can only be procured from 15-minute dispatchable resources. Currently it's hourly, and the reason we want to make this change is because if the contingency occurs and you call on spin on the interties and the contingency is then resolved, there's no reason to maintain that schedule on the intertie for the rest of the hour. So after the contingency is resolved, we want to open up that capacity again. So 15-minute, in order to receive an AS award on the interties, you will now be required to be 15-minute dispatchable. I got a question offline on this also about needing to distinguish between firm and non-firm transmission for hourly block resources. As the market works today, if you're receiving AS on the ties and it is hourly, you have to have firm transmission. Now, hourly blocks won't be able to provide AS. So we will no longer require hourly blocks to have firm transmission because the hourly block will not be able to provide AS. That's not in the paper. That's a clarifying point, so I will add that into the next paper. So continuing with this discussion, right now we award AS using a single dynamic operational ramp rate. And this is limited in the master file by the operational ramp rate is provided in the master file, and it is limited by the certified AS capacity. The regulation ramp rate that's used for our AGC can actually be lower than the dynamic ramp rate, but if a contingency event occurs, we will use the operational dynamic ramp rate. That's different than it's done today, and this is for operational needs. Deviations now will occur only as a result of a contingency. So when we are in a contingency, the regulation resources will use the dynamic operational ramp rate as opposed to the regulation ramp rate. I will also note that today plant operators are able to do a manual override in the EMS system to update the dynamic operational ramp rate. We are removing that override functionality. If there truly is a plant outage or something's going on with the plant and the operational dynamic ramp rate has changed, the plant operator will be required to submit an outage management system card, which I think makes total sense because sometimes those overrides get put in EMS and they get stuck there. Our operators don't have visibility to them. They don't know there was an outage, and then the wrong ramp rate is being used. Causes problems. So that will be a change going forward, and this in general will ensure deliverability based on what's awarded in the market. So this note is on the AS self-provision qualification process. So the CAISO is going to continue to support AS self-provision, but we are removing the qualification process. And the reason for that is the qualification process occurs before the market happens. It's not in the market, and it's using, as George coined, legacy code. It's not co-optimized in the market, it's not efficient, and it takes extra process fees by the CAISO. So instead, we're going to put that in the market. It will be more efficient and eliminate manual processes that need to occur today. We'll have no impact to market participants or scheduling coordinators, but we wanted to make note of it. And we'll ensure that AS maintains priority through the use of penalty prices and is still co-optimized along with other products. Market power mitigation that occurs will now also be moved to 15 minutes to align with the 15-minute scheduling in the day-ahead market. I will note that there is an ongoing initiative, I think it's actually wrapping up, the local market power mitigation enhancements. And LMPME was designed specifically to analyze more accurate local market power mitigation in the real-time market as opposed to the day-ahead market. And an outcome of that was that we are eliminating the balance of the hour mitigation. So that's a side note. Can you hear me again? Oh, good, I'm back. Okay, actually, before I go to this, we'll pause for questions on the last couple of slides. So we'll take questions in the room first, and then we'll go to the phone.
Carrie Bentley with the Western Power Trading Forum. So backing up to your AS slide, you said that currently interties providing ancillary services have to have firm transmission, but you're removing that because now hourly blocks cannot provide AS.
I'm glad you brought that up. So no, AS on the interties will still be required to have firm transmission. However, because hourly blocks can no longer provide AS, we will not require hourly blocks to have firm transmission because they're excluded from providing AS.
Okay, thank you. I just wanted to make sure that's what you meant.
I'll make sure that's in the paper too, that we still are requiring firm transmission for intertie resources that are providing AS.
Right, great. And then on the market power mitigation piece, will the CAISO be changing the opportunity cost methodology to use 15-minute prices, or will that remain hourly?
Can you elaborate what you mean by opportunity cost methodology?
This is Brad. I think I can clarify. I believe the opportunity cost methodology currently is based on 15-minute market, 15-minute prices, isn't it?
I'm not sure if it's a day-ahead market or not, and then I'm not sure when you move it into
the opportunity cost bases the calculated opportunity costs on 15-minute market prices, because that's the prices that would result in the final dispatch of the resource. So I think, I'm not positive, I think it's already based on 15-minute market prices.
Okay, good.
Let's talk about the opportunity cost adder.
CCE3, default energy bids, yeah. That's I don't follow it, but I want to make sure that everything was aligned.
Well, no, if you're suggesting that the CCE3 evaluation methodology needs to float now the simulation for the calculation of the opportunity cost on a 15-minute basis for the year, we were not planning to do that.
I think it already is, George.
When you run a production cost simulation for a resource for the entire year, right now, CC3 is using an hourly interval, right?
I think
it's used 15. If it's using 15, then we don't have a problem.
I don't need an answer now. Maybe just in the paper, you could clarify.
I think it might be.
Thanks.
Yeah, I think it uses 15.
Thanks. Operator, please open up the lines.
Hi, we do have a question in the queue. Caller, your line is unmuted. Please ask your question.
Hi, it's Mark Snap. I had a couple of questions have already been asked. AS needs to be sustained for 30 minutes. It sounds like for intertie ancillary services, you're not going to require it to be sustained for 30 minutes, just 15?
Mark, no, it has to sustain for 30 minutes. What we want to do by only using 15-minute dispatchable interties, what it gives us the opportunity is to dispatch that for as long as we need for the contingency event, and then we can actually return it back to its previous schedule, and then actually recover the AS on that intertie schedule.
Okay, thanks, Doug. And I guess maybe this demonstrates my ignorance, but what is a dynamic ramp rate? I mean, I know of a best, a worst, a market, and an operating ramp rate, but I don't know what a dynamic ramp rate is.
So the dynamic ramp rate is the operational ramp rate that's used to respond to dispatches. Going back to my notes.
Okay, it's not a new entry to the master file. You're talking about the operational.
No, it's not. Yeah, it's the operational ramp rate. Yeah, and then the regulation ramp rate is used specifically for AGC.
Great, thank you.
So the terminology that we use here, when we refer to the term dynamic ramp rate, what we mean is that the ramp rate for a resource is not fixed for the operating range of the resource, but there are different segments of the operating range that could have different ramp rates. So essentially, as the resource is dispatched or scheduled at different levels through the various intervals of the market horizon, its effective ramp rate may be different. That's what we mean by dynamic ramp rate.
Very good. Thank you. That's it.
And there are currently no additional questions in the queue.
Steve Keene from Navigant. For a 15-minute intertie resource that's given AS in the last 15 minutes, do they need to show firm transmission just for that 15 minutes or for the next half hour?
Yeah, I've thought of that, and I actually asked the same question. Coming from a scheduling background, I'm envisioning that just because you have an AS award doesn't mean it's going to be an AS award for the whole day. So what happens if you're awarded AS for the last 15 minutes, but not necessarily the next hour? So my assumption would be if that situation occurs, that the tag would need to be updated for the if you were dispatched for the last 15-minute interval of the operating hour, you would then need to have the E-tag updated for the first 15 minutes of the next operating hour so the energy would flow and to ensure the transmission capacity was there.
And the second 15 minutes, because if you get dispatched at 5 minutes too, you have to be in both of them.
Yeah, exactly, yeah. There would have to, in that scenario, there would have to be some type of updating to the E-tag so the output could be withstained for the 30-minute requirement. All right, so I'm going to move forward. We were to slide 10. Design feature 10, slide 24. I don't think we want to go back to slide 10. So this really is settlement modifications that are needed to change modifications to the expected energy calculation. So, Standard ramping energy, SRE, is used to insulate scheduling coordinators from real-time market changes if they only participate in the day-ahead market. So if they're participating in the day-ahead market and they have changes in the day-ahead market between hours, but then self-schedule into the real-time market, we insulate them from imbalance energy prices by calculating the standard ramp, which is symmetrical across the hour. So it's from a 20-minute ramp currently across the hour, T-minus 10 to T-plus 10. That's calculated and is a standard value, and if you follow the standard ramp, there are no charges with that, and it's not settled. Ramping energy deviations are if you don't follow the standard ramping energy. And when this occurs, you're settled at the real-time dispatch locational marginal price. We also have residual imbalance energy, which occurs if there are changes between your day-ahead schedule and your real-time schedule. And then you have to go, let me see if I can muddle through this. I asked James, and of course our settlement guy isn't here. So let's assume hour ending 1 and hour ending 2, you have a 100 megawatt schedule in the day-ahead market. And then in the real-time market, you're dispatched up for the last third and fourth interval of the hour to 125. You then have to ramp back down to 100 to follow your day-ahead schedule for hour ending 2 of 100. So those ramp changes have to be calculated, and you have to ramp back down to your day-ahead schedule. And this is what we call residual imbalance energy. And the residual imbalance energy is settled at the reference interval bid if you have bid into the real-time market and your schedule is changing as a result the bid. If you have not bid into the real-time market and instead have self-scheduled, but a schedule change occurs anyway, and in that case there'd be no bid price, so we use the real-time dispatch LNP if the reference interval bid is not available. So that's background on those three topics, and the takeaway is the bottom half of this slide, that today those are calculated SRE and RED are calculated hourly for the hourly ramps. Going forward, we'll have to calculate those between the 15-minute ramps as well. So the hourly ramp is 20 minutes, T-minus 10 to D-plus 10. These 15-minute schedule ramps will, or 15-minute interval changes will assume a 10-minute ramp. And the reason we picked 10 minutes is because that's currently used for the ramping of the intertie resources. So we'll need to make changes to SRE and RED. However, the residual imbalance energy is currently calculated on a 5-minute basis, so I added this in for context, but we don't need to make any changes for that. Demand response. So demand response will also be able to participate with 15-minute granularity in the day-ahead market. The demand response resource will need to designate the interval with which they're able to respond to dispatches, and that designation needs to occur in the master file. So whether it's an hourly demand response resource, a 15-minute demand response resource, or a 5-minute demand response resource will need to be designated in the master file so we can schedule it appropriately. And if the demand response resource designates the hourly block option, very similar to our interties, it will only be scheduled if it's economic over the 4 15-minute intervals of the operating hour. The baseline calculation is used for the net benefits test, which that's a monthly price using gas indices to ensure the demand response resource is economic in relation to the load it's serving. Is it better to drop load or use your demand response resource? Currently, the baseline calculation occurs hourly. That will now need to occur on a 15-minute basis. Unless it's an hourly demand response resource, and then it would occur hourly. So it's hourly for hourly block demand response resources, and if it's a demand response resource that's 15-minute dispatchable or 5-minute dispatchable, we'll use a 15-minute baseline calculation. Yes.
Steve King, African again. The hourly block for demand response is different than the hourly block for a regular resource. This is only dispatched if it's economic in every 15-minute interval. The other ones are dispatched if they're economic on the average across all 4.
In relation to internal generators or intertie resources? I think of it more similar to internal resources. Do we even allow hourly block scheduling for internal gen?
There is an option to use hourly scheduling for hourly proxy demand resources, hourly reliability demand response resources.
RDRR.
Yeah. Yeah, the understanding is that the process will be similar to the hourly intertie blocks, and the settlement will be similar, so there shouldn't be any difference between those two. You're alluding that there should be a difference, but we don't plan to.
When I asked before, I was told that the hourly blocks would be dispatched if they were economic across the average of the 4 blocks.
And you're correct.
But this says they're economic. If they're economic over the, okay, I see what you're saying.
The same, yeah.
Any other questions in the room? Operator, do we have any questions on the phone?
We do have a question on the line. Caller, your line is unmuted. You may ask your question.
Hi, this is Paul Nelson with Plika. Got 2 questions. So on the demand response, is the P-min 0 problem still a problem?
We're not addressing that in this initiative. I know they're working on that in the ESDR initiatives.
That's actually that's actually would be implemented as part of CCW changes. The min load cost for resources is 0 P-min.
I think he's talking about the P-min of 0.
Yes.
You know, the 0 P-min for PDR. That was the question, and Don is right. This is not addressed in this initiative. It's part of ESDR, right?
Yeah, but CCW also allowed min load costs for resources with the 0 P-min. Yeah. But anyway, it's not this initiative. Yeah.
I was just a clarification to make sure that the issues that we've seen in real time also exist in the day-ahead and market enhancements, and I assume that was the case. The second question I have actually goes back to the hourly, the ancillary services and using intertie resources, and the movement and the requirement that it has to be 15-minute, which really then, because of you have to have sustain up for 30 minutes means you have to have at least 30 minutes of transmission. And the question I have is, do other balancing authorities allow you to purchase transmission in 15-minute blocks or 30-minute blocks? Because I thought it was you kind of had to buy transmission in an hourly block.
So it depends on the rules of the other balancing authority areas. I know transmission is still typically an hourly market, and some balancing authority areas still use hourly block transmission. However, there are others that do allow 15-minute transmission. I know SMUD, for example, is one of those entities, so I think it depends.
Okay, because I guess if you move to this, then are you risking dropping the hourly AF product that you get today because they would no longer then participate? Is that a risk, or is that even a problem?
But Paul, I think the same problem exists with an hourly product, that if you are holding AF on it and then dispatch at the last 5 minutes of the operating hour, you still need to sustain that output. So it.
Well, I thought, okay. All right. Well, thank you.
And moving to the next question in the queue. Caller, your line is unmuted. You may ask your question.
I'll just go in again. The question is also on the AF. So just a clarification. So when they get an award, is it going to be 30 minutes of work, or is it going to be 15 minutes of work?
It will be a 15-minute award.
So if it is a 15-minute award, then what is the point of sustaining the output for 30 minutes then?
That's a tariff requirement, so we're required to maintain spin and non-spin, or the resource is required to maintain spin or non-spin for 30 minutes, and I believe the justification for that is that's back to the NERC standards. The ISO has 30 minutes to respond to a contingency event, so if we call on ancillary services, we need to ensure that they're available for the full 30 minutes with which the ISO balancing authority has to respond to that contingency.
Actually, I'll provide some additional context. I think this might be the first initiative I ever worked on. Which is we used to require 2 hours for output to be sustained for all ancillary services. But when we started to open it up to other resources, we realized that what we had basically done is set the requirement, assuming a conventional generator was going to provide it, which going 2 hours isn't that much of a problem. And so what we did is we looked at the length of it usually takes us to recover from a contingency event. It's usually less than 15 minutes. And then we wanted to then have the opportunity to go back and let the market start taking over versus contingency dispatch, and that's how we came up with the 30 minutes.
Yeah, I have a concern here. For example, I have a 100 megawatt resource, and I got 60 megawatt for energy and 40 megawatt for spinning, for instance. But then that award I got is only for one 50-minute interval. And then go to the next 15-minute interval. Price is very high, and I don't get any award for spinning, but I still have to hold my headroom of 40 megawatt. I cannot convert that to energy, so that is where I don't understand. At least the result should get an award for even that 15 minutes. That's should be compensated.
And
for
you
that.
could ensure you have an hour of AS awards based on your bidding behavior. So the 30-minute requirement is not new. It's not changing. It is what it is. All we're saying is that you have the ability now to schedule 15-minute AS and not just hourly block AS.
I understand that, but that does not answer the question, though. You got an award. You have to hold it for extra minutes without any incentive. So that's my point.
I think what you're asking, are we going to ensure in the market that we give you an AS award in one 15-minute interval, that we don't then dispatch you for energy in the second 15-minute interval such that you can't meet the 30-minute dispatch requirement?
Right.
So, to answer that specific one, for limited energy storage resources, that we calculate schedules and awards subject to the state of charge of the device that we track in the market. We make sure that when an ancillary service award is awarded, this 30-minute sustained energy delivery is factored into the requirement for the state of charge to be available to support that. But for regular generating resources, we don't, of course, monitor any energy capability because these are not limited energy storage resources. And as Don mentioned earlier, this was never an issue for generating resources. But for batteries, we do make sure if we award spin in a 15-minute interval, the state of charge of the device is coupled for sustaining delivery of energy if we convert the spin to energy for a 30-minute period. And I have to provide a little bit of clarity on where is this requirement for this 30-minute sustained energy is coming from. This is an operational reality when you have a contingency. And as Megan mentioned, we have to recover the contingency within 30 minutes. But even if you recover the contingency, let's say best case scenario within 10 minutes, you have loaded your spinning reserve resources that are producing energy. You're going into the next phase after you recover the contingency to recover your operating reserves. So you have to moving back the units that they're currently providing energy out of the spin, you have to move them back to recover the capacity and have them available for the next potential contingency. So this movement, this recovery of operating reserves is not immediate. It's not automatic. It doesn't happen all at the same instance. So after 10 minutes, just drive all these units back to their schedule, because that will be a second shock to the system when we give at that point. So this recovery takes a little bit of time. The operators recover the operating reserve in the system gradually, and that takes a little bit of time. So that's why the requirement for 30 minutes sustained energy is there to give the time for operators to recover the spinning reserve gradually in the system and not shock the system again after recovering from a contingency.
No, I appreciate that, but it doesn't seem to be a financially viable resource. I want to come back to my example. If I have a 100 megawatt resource, and you give me in one 15-minute interval, you give me 60 megawatts of energy and 40 megawatts of work for spin. So in the next 15-minute interval, the question I have is, can you dispatch me beyond 60 megawatts, let's say 70 or 80 megawatts for energy? Because now price is very high and the resource can provide energy. But just because it gets the spinning award in the previous 15 minutes, you set the headroom for it, and it can't be used for anything else. So this, I understand the question right. I understand what you're trying to do here.
So the best example that I can give you that you can see how this plays out is, let's say you have your 100 megawatt resource and you have an energy bid for that resource all the way to 100 megawatts, all the capacities in the market, but you also have an award for spinning reserve of 20 megawatts on a 15-minute interval, okay? So what happens is that top 20 megawatts of the resource from 80 to 100 is reserved from the market. We reserve this capacity for a contingency. So your resource could be optimally dispatched up to 80 megawatts. Even if your energy bid is in the money, so to speak, so that if we were not reserving the capacity, you would have been dispatched all the way to 100 megawatts, we don't do that. We reserve the 20 megawatts for a contingency. Now, when a contingency happens, okay, your resource will be dispatched to 100 megawatts, releasing the spin, all right, as energy. What we're saying here is after the contingency is recovered, the operator does not want to move this resource immediately back to 80 megawatts to recover the spin. So this is a gradual process that may take some time, and that's why we require you to have the sustained energy provision over 30 minutes to allow for that to happen. That doesn't necessarily mean that your resource will be out of money. Your economic bid could be in the money, so you're not necessarily, in the example that I'm putting here, you're losing money by being dispatched as energy.
Hey, this is Mike Castellano from DMM. Let me try this one. George, I think what Kwong is concerned about is if he has a resource that sells that 20 megawatts of AS in interval 1, and then in interval 2, the optimization buys that 20 megawatts of AS from somebody else, then can his resource sell that 20 megawatts in interval 2 as energy.
I assume that in interval 2, if he didn't get a spin award, if its energy bid was economic, it would have been already dispatched as energy on an advisory basis, and when we get to that interval, it will be.
Okay, but then does that bring up a complication that if there is a contingency in interval 1 and you need his 20 megawatts of energy for 30 minutes?
So, what I said before was that if the contingency happens in interval 1 and we dispatch this resource, we don't dispatch the resource that has contingency in the second interval because the contingency happens in the first interval. What we want to do is after the contingency is recovered, while we're on interval 2, we want to have some time before we drive this resource back down to its schedule to recover the spin. This process will take some time, so that's what the additional 30 minutes is there for.
Right, but then for interval 2, doesn't the market have to go and procure something else to replace the 20 megawatts that he sold as energy in interval 2 that you're now using as spin?
No, because in your example you already mentioned that that spin for interval 2 was provided from another resource, so we're good.
Right, but you haven't dispatched that, so you're 20 megawatts short in interval 2, aren't you?
No. The interval 2 spinning reserve has not been dispatched, it's still been reserved as energy, as capacity.
Right, but
now because we're running a resource from interval 1, we're still running in interval 2, you need to rebalance, assuming that your load hasn't changed. Yes, some other resource will probably be below its schedule. Is that what you mean? Because we're running this resource, we're still using it as energy above its 80 megawatts, then some other resource needs to balance by being further down temporarily until this resource is driven back to 80.
I must be really lost, George, because I'm completely.
I think I understand the issue. I think it's not easy to talk about it just simply in words. We need to actually draw an example. So we'll take it offline and work through it.
And I'm also very confused as well. Very simple example, like you said, it's 80 megawatt of energy and 20 megawatt of spin award in 1 hour, in 115 minutes, and then the very next interval, can you dispatch that resource for energy to 90 megawatts?
I understand your issue exactly. I think we want to take it back and discuss it so we can actually put it on a whiteboard and look at it versus just talking about it.
Yeah, that would be very helpful. Thank you.
So with that, it's a little after noon, so I think it's time for lunch. If there's any questions, please hold them until after the break. I should be able to finish up the phase 1 stuff in about 15 minutes, and then I'll pass it over to Elliot. So we'll take lunch now, and we'll meet back here at 1 p.m.